Hello, everyone. Hope you're having a good day. My name is Majesty. I'm an Atlanta-based real estate developer with $13 million in assets under management and another 50 million in the pipeline. I build and rehab apartment buildings. So stick around for some real estate tips. And I'm doing a series of 100 questions in 100 days that I get pretty commonly. So today's question is, how do I finance my first real estate investment? So this is an important question because you need money to be able to, acquire a property. You can't. It may not have to be your money, but it has to be some money. Like nobody's just gonna, even when they give it away, there's a tax benefit. So you need to know how to structure the transaction financially so that you can close and take ownership of the property. And so I guess, this goes back to kind of what I said in the previous video about determining your strategy, making sure you understand how you're going to exit, because that depends on who you go to and how you structure the financing. But I'll kind of go over the general concept of the different major funding sources. So essentially, the first thing you have is your traditional loans. That includes your conventional mortgage, which typically requires, like, it has some requirements like credit score, down payment. Right now, I'm hearing about 680 is a good credit score as far as minimum. And then also the down payments are ranging somewhere between about 10 to 20%, probably closer to 20%. And that's for a conventional mortgage. You also have FHA loans. That's the one that most people hear about. That's the one that has the lower down payments, typically somewhere between about 3 and 5%. There are opportunities to get it to zero with some different programs if you combine that. You also have VA loans. And that's for the veterans, people that have been in the military, served in the military. I truly wish more people that served in the military would take advantage of the VA loans, because they have zero down. So you can technically get into a property without having to bring any thing out of pocket. So I don't completely understand why more veterans don't use it. Maybe you guys can chime in and explain. But that's kind of the structure. I haven't gotten one myself. I'm not a veteran, but I do know veterans that have it, and it's definitely been instrumental for them. There's also alternative financing, and this is usually for properties that need a little bit of a creative approach to get them where they need to be, but hard money loans. Those are kind of, I wouldn't say predatory loans. They're definitely opportunistic in terms of they have higher interest rates. They mature quicker. Like maybe you get 6 months to 9 months to 12 months to kind of do what you're going to do with the property, whether it's fix and flip, or sometimes just a bridge loan, so that you can hold yourself over until you can get another loan, which is interesting. But that's one of the main options that investors use to fund their flips and their deals. You also have private lenders, and those are typically people that just have money. It can be anything from, like a doctor with some savings, all the way up to some high net worth individual that just wants to put money into a deal. So that can go a lot of different ways, but it's someone with money. There's also a home equity line of credit. Um, and you need to have a property in order to use this, but you're able to basically take some money out of your property in the form of a line of credit. They'll give you a line of credit that you can access based on the equity in your home. The terms are, they kind of vary, but you can get a certain percentage of the equity available in your home to access, and you can pull it, just pull cash out, make charges against it, write checks against it. It's like a bank account where they put money into, and it's secured by the equity of your home. So, that's one way to get funding for a deal. You also have different creative financing options, and this gets a little bit more complicated. You kind of got to have a good understanding, or at least enough to be able to communicate it to the person that you're working with, like the buyer or the seller. But owner financing is one of the main creative financing tools used, and that's just when the person selling the property is willing to wait to get their money. They don't need all the money right at closing. Like maybe you give them half, and then you pay them, some payments over time, or maybe you give them nothing, and you don't pay any payments for 5 years, but the whole thing is due in 5 years. They want you to get another loan to pay them off. But there's a lot of different ways to structure it. This works best when the person that owns the property has, like control, and they're kind of, I guess you could say stable enough to be able to do that. So you have to find the right deals for that, but they do exist and they happen every day. You also have lease options, and that's basically kind of like where you rent the property with an option to buy it at a pre negotiated amount. So you're renting it with the hope that you can figure things out and close on it before the end of your lease term. So that's an option there. You can also do subject to, and this is another creative one. You kind of want to have an understanding of it, but basically you take over the mortgage that already exists on the property. So I kind of like the VA loan or what have you. You can buy that subject to, so that way the veteran that wants to sell their home, you can take over their mortgage and basically pay their mortgage for them. And that's how you can acquire the property, but just basically almost like acquire the loan in a sense, and typically requires a down payment or something like that. But it is possible. There's different requirements depending on the loan, um, and it's something that you have to look into and learn a lot more about. But it is out there. It is possible. There's also plenty of government programs, usually kind of particular to the city or the county or the state that you're in. But there's a lot of first time home buyer grants, and that's what I was referring to earlier, as far as how to get your FHA loan from 3 to 5% to zero. They'll give you a loan or a grant or something like that against the down payment that you're supposed to bring. Or in place of, they'll give it to you. So you end up not having to bring anything to the table. There's some requirements for that, of course, but it is possible. A lot of people do it every day. And there's also just sale assistance and federal programs. Like I believe there's one that Biden is or did roll out in regards to a credit to try to get the prices under control. I don't know how much it's going to help, but it's there, and I think it's $10,000 or so. I don't know how much that's going to help with these prices, but there's also joint ventures, and that's basically when you partner with someone to do a project, and they can bring their resources to the table so that you don't have to. Maybe you bring the deal, they bring the money. Or you bring, a GC brings, the work to the table, you bring credit, they bring, the equity needed. So there's different ways to kind of get it done. Um, Obviously, real estate groups, that's a great place to kind of meet with other like-minded people and people that are willing to do deals with you. So that's a great way, just networking. That's probably going to be your best way to find people to do joint ventures with, referrals, meeting people through other people. So that's a good one. And either way you go, though, you want to make sure that you do a few things. One of those is make sure that you have good credit. And if you don't, make sure you work with someone that does, because there's usually going to be some type of credit check. So you got to be ready for that. Um, Having a partner doesn't work as much for the government backed ones, like the FHA and all of that. They kind of want to see your stuff unless it's like your life partner or spouse. But the hard money lenders and some of the more like commercial lenders, they will allow you to be a partnership. And whoever has the best credit can be the one that kind of goes on the application. So that's one way around it. But that's more specific, like I said, for the commercial loans. You all also want to be prepared to pay a down payment. If it doesn't have to be your money, It could be money that you raise. That's basically what syndicators do. They raise the money for their deals, you know, through different means, crowdfunding, all of that. So it doesn't have to be your money, but some money's going to have to be put up somewhere. And you typically expect about 10 to 20% of the total cost that you're going to have to put into the deal, or someone's going to have to put into the deal on your behalf. Also, your financial documents, they're going to want to see different things: tax returns, bank statements. They're going to want to see how you plan to pay for the loan. That could be pay stubs, like FHA loans. I know they do pay stubs and tax returns. So you want to be ready for that. Most investors are going to want to see that as well, just to know what they're dealing with. Know that you're credit worthy and that they can provide the loan. Even when you're doing like owner finance, they may want to see that. They're giving you a loan. So anybody giving you a loan typically is going to want to see your credit history. So just, kind of be prepared for that. And this list is not all inclusive. There's other ways to kind of get it done, and a lot more complex ways like bonds and, LIHTC equity, and it can get pretty complicated. But those are the main ways that most people are doing deals and financing their deals. So I would encourage you to kind of explore options, but definitely take action. Like, comment, subscribe on this video. Ask any questions that you have. I'll be glad to do a video about it or answer in the comments. I appreciate you guys checking out this video, and I'll catch you on the next one. Thank you.